rates coming down even now in his book, and therefore portfolios could be positioned accordingly. Prablin Bajpai, thank you for joining in. Do you second that, or is your view slightly different? Because I've heard both ends of the call, right? Some people are saying that no, there could be a possibility that if Trump comes in and he levies tariffs, then it could be inflationary, and the US Fed could raise rates. India might be forced to not cut rates, and therefore the portfolio could be structured completely differently. How do you think about it?
Good afternoon, Neeraj. First, let's talk about Fed. I think something they've said is that they are not on a preset course, so they are going to act on the incoming data that they are going to receive, and these are the words by their chief at the Fed Reserve. And I think they will actually wait and watch and see how the Trump administration, once he's actually rolled out the policies. What is the implication? And I think they would act accordingly. And they've sort of remained open-ended on both sides that we can increase and decrease the rates. In India, I think, again, we are at a very crucial juncture. We have the new RBI governor now, and growth has been sluggish. Earnings, of course, have been disappointing. Inflation slightly contained. I think it should get better. So I think 2025, again, is going to be a lot of balancing act by the Reserve Bank of India. But there may be a delay, Neeraj, but there will definitely be a rate cut and rate cuts coming if we definitely want to maintain the growth trajectory. I don't think that that's something that can be avoided. But again, the timing, because we've been talking since July that maybe it's going to happen in October, then December. Now we are saying February, and maybe I would say it can go forward till April as well.
Okay.
But even if that remains the situation, I think rate cuts would eventually happen. And tactical allocation, what Mr. Jajo mentioned, I would say, as a tactical allocation, some allocation towards the longer duration funds definitely makes sense at this point. And, we can definitely earn double-digit returns if the investors are careful with the time horizon that they pick there and, eventually exit at the right times. And this is something, Neeraj, I'm talking on the basis of the past data. If we just look from 2019 onwards, the annual returns, the longer duration funds back in 2018, we were sitting at the same repo rate, about 6.5. And 2019, we of course saw, multiple rate cuts. And by end of 2019, we were at 5.15%. And this was pre-COVID. So these were not rate cuts basically due to COVID. And of course, the longer duration funds, reacted positively, and the returns went up to about 12.5% for the category. At the same time, the low duration and the shorter duration funds were giving about 4 to 6%. Same followed in 2020. But then when you're already at the bottom, because by end of 2020, we were sitting at about, I think, 4% repo rate. So when you're sitting at the bottom, then the longer duration funds start becoming risky. So one thing that investors shouldn't do is look at past returns even in debt. That is a big no, because then they would have sat with these, meager 2% returns in the longer duration funds, because the reverse happened. The interest rates started to go up. But I think 2024 has been good, and 2025 also should give somewhere between double digits. But I think the timing and everything here, the other factors which come into play will be important. So with a 2 to 3 year horizon, definitely a longer duration fund can be chosen as a tactical allocation.
So just Prablin, can you simplify this, because a lot of people might just get confused about what. So let's assume there is somebody with medium risk duration, medium age profile, medium income level, wants to create, let's say, a fresh fixed income portfolio or rebalance the portfolio. Now we don't know what the past is, but that's okay. But let's assume if you had to just create a fresh portfolio, what kind of funds on the longer side, long duration side? I mean, would you could you consider lay it down for us?
So I think if I have to allocate the whole 100 rupee within the fixed income side, then it would be a tactical allocation would be somewhere between 20 to 30% perhaps, depending on how savvy the investor is. And that is where we would choose the longer duration funds. There are, any of the good credible fund houses, starting from Mirae to ICICI to Nippon, any of the good credible fund houses can be picked. And this is the allocation that you're looking at, sort of trying to make use of the interest rate cuts which are proposed and, we are all very hopeful about in the coming times. And this is the allocation which you should be taking with a 2 to 3 year horizon. and stay put till the time we don't see 2 to 3 to 4 interest rate cuts in that time period. And the remaining 70%, I think, has to be your core within the fixed income space. And that will be your standard short duration products as well as the corporate bond fund, the regular standard debt funds where they can allocate across different time periods as well as in corporate bonds or gilt funds. There is no limitation. So there is no limitation on the duration, much duration on this side. So short duration would be 1 to 3 year holding period. I think that again gives a lot of flexibility. And corporate bonds, of course, only have to invest 80% in corporate bonds. They have the flexibility for the remaining 20% with no limitation on the time factor. So a 70-30 allocation between the core and the tactical for a regular investor.
Okay. Okay. Interesting. Okay. Prableen, one last question. What are the risks to this theory? I mean, is it lower returns or can it be, I mean, and what should somebody who's creating this portfolio watch out for in order to rebalance it should the event happen?
So on the longer duration fund side, Neeraj, most of the holdings are, the gilt fund, gilt and government securities broadly. So we don't see any credit risk there. The red flag, or I mean, on the negative side, what can happen is that you don't make great returns. The interest rates cuts are not happening. So the returns will work out to be very meager. That's one risk. And there can be a delay in the whole process. So, investors may run out of patience. But on the other side, I think the short duration funds and corporate bond funds, I think they are more like the all season. So I think that area is something where there is not much risk. And overall, I think credit is something that investors should be wary about and not take allocations to. So they, even in the fixed income space, Neeraj, past returns shouldn't be considered, because I think fixed income is actually a more complex arena and space as compared to equity funds sometimes. So I think a simple strategy with the core and satellite or the tactical allocation should be taken.
Okay, Prableen, thank you for that. Some queries, Prableen, I would like to take a couple of them if we can. So Neeral Vaishnav, 42 years of age, puts in the first question. Which multi-asset allocation fund should Neeral consider for a 10-year investment horizon, and why? Any thoughts?
So multi-asset allocation again is going to give exposure to 3 different asset classes. And Neeraj, this is a segment again where we've seen a lot of new funds, in the near past only. So there are about 26 funds and only 6 of them have a track record of more than 10 years. On rolling return basis, out of those 10 funds, I would say ICICI, SB, and HDFC look good. Quant I didn't name because it's more volatile. So in terms of its standard deviation is much higher. For those funds which are slightly new, I think Nippon looks nice. So the allocation should ideally depend on, after looking at the other funds in the portfolio, so there is no over concentration of a specific fund house or an investment style. But I think these are some of the multi-asset allocation funds which can be seen.
Okay. Yasir, age 30, the goal is to generate dividend income currently, investing 25,000 in ICICI approved regular savings fund. Should Yasir continue investing or should Yasir diversify his portfolio?
Neeraj, I think Yasir should definitely come out of this fund, because even if he's looking to generate dividend income, number one, that of course, dividend income, if he's taken the IDCW plan, it is taxable at slab. And if he's not taken the dividend income option and if he's in the regular growth option, then also conservative hybrid category is now as considered a debt and it will be taxable at slab. So if he wants to contain his risk and be in a hybrid category, sort of lower his equity exposure, I think still some other category within hybrids can work better. And from that, a SWP, a systematic withdrawal plan, will be much more efficient from taxation point of view. And I think managing the monthly income that he's looking at instead of dividend income, because again, your own NAV, your own returns are going to come back to you in a mutual fund. It's not like stocks where the dividend is over and above your share prices or your earnings that you've made.
Okay. Okay. Probably in one more, Rahul Yadav is asking this question. Rahul's age is 34. Rahul is investing 15,000 rupees per month in the following funds with a 5% step up every year. Should Rahul continue or change the diversification? Parag Parikh Flexi Cap, Axis Small Cap, an SBI mid-cap fund?
So all the three funds are decent. One flexi cap, one small cap, and one mid cap. But the answer ideally would depend on the holding period, Neeraj. If it's a 15, 20 year portfolio, I would definitely make more changes to it. I would add a large cap index. I would probably change the mid cap also to a passive mid cap. But if it's a 7-ish year holding period, or within 10, let's say up to 10, then probably he can continue. If he's been continuing with this for last, let's say 2-3 years, then I would not disturb it because they're reasonable funds. With a 15,000 SIP and a 5% step up, he can create roughly 41 lakhs in 10 years, assuming a 12% XIRR on the overall portfolio. And if he stays on till 15 years, he can create about 97 lakhs for himself. And if he's able to do a 10% step up, I think on 15,000 SIP, it'll be great if he can do a 10%. Then he can create roughly 50 lakhs in 10 years. But the compounding would really come into play, and he can create close to 1.3 crores in 15 years, again at 12% XIRR, which is, I think, a very conservative approach. So overall, one large cap index can definitely be added at this stage. And if the horizon is really long, then probably some shift, in the strategy can be taken slightly, then a mix of active and passive funds.
Noted. Prableen, okay, noted. Prableen, take a moment to thank you for joining in today. Really appreciate your time. Season's greetings. Have a great Christmas.
And thank you. Same to you and your viewers, Neeraj.
Thank you so much. And viewers, that's it on this leg of the Mutual Fund Show. Thanks so much for tuning in.